All right, so today I wanted to talk about another company that is, I think, very good. I've never talked about before, but if you could get it at the right price, I think that it would definitely be a buy. So let's get right into it. MPWR, Monolithic Power Systems. So again, they're in the semiconductor industry, $36 billion market cap. They do pay a dividend. Free cash flow yield only 1.5%. That's definitely one thing that I wish was a little bit higher. Getting right into it, if we break down the insights, management, again, when you look at return on equity, return on invested capital, they're doing a very good job there. Stock-based compensation is certainly a concern, but with a lot of these tech companies, that's something that is, somewhat normal at least, if not normal. When you look at the profitability, this is one of the many areas this company really shines. Again, operating margin 24%, net margin 22%, free cash flow margin 31%. Those are all very, very good numbers. When you look at growth, it's a little concerning because right now things are pulling back a little bit, but when you look at next year's projected earnings per share, they're projected to grow at 72%, which again, so in the short term, it's a little concerning, but in the long term, it's not concerning. Financial health. This company has a very good balance sheet. That's one of the many reasons that I really do like it, because in a higher rates environment, having a weak balance sheet just means that you're going to be paying more for your debt. It's going to be harder to grow. So again, if you have a strong balance sheet, that's something that really helps out. And not to mention too, it's typically a sign of good management, because good management it's usually smart to be effective with deploying capital and not taking on too much debt. Dividend I'll get into in a minute. Valuation, again, they are very expensive where they're at right now. I'll get into where I would be buying them at, but again, a price of free cash flow of 64, a PE of 89, too expensive, but again, we'll get into that a little bit more. Checking out its balance sheet here. Again, the balance sheet is very strong. Assets to liabilities is 86%. So when you look at their liabilities, you have 384 versus assets 2.4, right? So almost 10x. And then when you look at just cash on the balance sheet, the amount of cash they have on the balance sheet could pay for the debt they have like 3 times over. So that's a sign of a very, very good company. When you look at the income statement here, revenue is just a consistent climb higher every single year. That's exactly what you want to see. Gross profit actually came down a little bit, but again, it's still the trend is still, I would say, intact, at least if you ask me. When you look at earnings, again, a similar story here. 23 was a little bit lower than 22, but again, they're still growing it very, very strong. They are issuing shares, which is something that does concern me a little bit, but the rate at which they're doing it seems to be slowing down a little bit. So that's something that I like. But again, companies that are constantly issuing shares, in my opinion, that's never a good thing. But if they're doing it and they're actually putting it to good use, then it not necessarily the worst thing in the world. When you look at the metrics here, again, like I brought up earlier, the profitability metrics, these are so important. Free cash flow margin is at an all-time high. Operating cash flow also at an all-time high. That is very, very good to see. That is something you definitely want to be seeing. When you look at return on equity, return on capital employed, 2022 was the highest they've been. 23 was the second highest. Same goes for return on invested capital. Actually, it looks like pre-2008 they were above that. But it's the highest they've been in 15 or 16 years. That's another thing that is exactly what you want to see. When you look at free cash flow per share, this is arguably one of the most, if not the most important metric. And 2023, they literally doubled in any of the next highest years, which again, that's what you want to see. But are they going to be able to do that every year? Absolutely not. I brought up that this company has a very good balance sheet. Again, current ratio, very, very good. They actually trended down every single year starting in basically 2012 up until 2021. They're actually trending back up, which is exactly what you want to see. But I mean, a current ratio of 5 is still very good. That's not bad by any means. It's still very impressive, but it's good that they're getting better there. If we look at the dividend, like I brought up, when it comes to dividend, looks like they started growing their dividend again in like 2018 or so. And again, they've been growing at 25% per year every year since then. The payout ratio, you're looking at 42%. Are they going to be able to grow at 25% a year for the next 5 or 10 years? I doubt it. But it's good that they are committed to that. And not to mention, if you'd have bought this company a decade ago, you would have a 13% yield on cost, which is just absolutely crazy. This company's absolutely destroyed the S&P over the last decade, 1,700% versus about 200%. If you go back 5 years, it's up 466 versus 94. If you go back, let's say 3 years, it's still up 129 versus 43. So basically every single timeline you use, they are easily beating the S&P. Is that going to happen in the future? Nobody knows. But again, oftentimes when you have a company that is very good in almost every way, typically they're going to repeat. Typically they're going to repeat the past. Again, no guarantee though. When you look at its valuations, going back a decade, the average price to free cash flow, the average is 429, which is insanely expensive, right? I mean, that makes virtually any company, that might be one of the most expensive companies in the whole market. The latest is at 89. The lowest they've been was 33, but again, that was back in 2014. If we go back, let's go back 5 years, just out of curiosity here. We are at, the lowest they've ever been was about 59. And that was back during the lows back in October of last year. So based on these metrics, I mean, if you can get it for a price of free cash flow of 50, that's a pretty big discount. Would I pay 50? I think that's still expensive. I think 50 is still expensive. But you also have to keep in mind that they've been growing free cash flow over the last 5 years, 43% per year, which is crazy. Over the last decade, they've still been growing 22%, which is still very good. So if we look at trying to get a valuation here, because this is the most important metric when it comes to looking at stocks, just because it's a good company doesn't mean you should buy it. Oftentimes you shouldn't be buying it. The key is buying good companies at good prices, or even at the very least fair prices. So based on this metric, these metrics I have typed in here, if they can grow free cash flow at 18%, which is less than what they've done over the last decade by a little bit, issue 3% shares every year, which I think is actually less than what they've been doing recently as well, grow the dividend at 15%, which is still less than what they've been doing, and pay a 35 price to free cash flow. Fair value is about 654, which is about 13% below where they are at right now. So based on those numbers, you're looking at about 650 to buy this company. Where is it at right now? It's at 751. So again, it's going to have to come down about $100 roughly. Again, this is just my numbers here. I obviously could be wrong here, but based on these metrics that I'm going off here, it would have to come down about 13, maybe 15% just to be safe to buy. That's not that significant. Now, again, the key here is you also have to keep in mind that can they maintain these levels of growth? Because let's say they grow free cash flow at 10% per year. That means that they're 54% overvalued. Like, it'd have to come down 54% for it to be fair value, right? I mean, let's say it does 15%. That means it's 31%. It would have to come down 31%. So you have to keep in mind that, again, these are just the numbers that I'm going off here. I could be wrong. I mean, this is all of these numbers are none of them I would say are aggressive. But you also have to keep in mind that 35 price to free cash flow is still expensive. That's by no means cheap. They're going to have to grow very significantly to maintain that. I mean, if they can grow, like if they can repeat their past successes and grow at 22%, they're actually undervalued. So that's another interesting factor here. I have no idea, because when it comes to these kinds of companies, it is hard to project. I'm simply going off my best estimates. I could be wrong. So anyway, that's what I wanted to bring up today. If you liked the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.